what's the difference between these two order block, right? So we have one order block right here, as you can see. Price go to the upside and come back and respect it and going to the upside. But this one, price completely violated and go to the downside. What is the difference? So in this video, we're going to talk about this matter right here. So here we have gold, which is really nice, really clean. But I'm going to show you the difference between the two that I just show you, right? So the first one being price created order block, right? And then when it come back down, it respect the order block really nicely, like this. And the second one, the same thing happened, right? But then instead of respecting it, price just go through it and completely destroy this order block. And if you're going to buy from this order block, you would have lost, right? So why is this happening? What is the difference between the two? So let's get started. So here we have really nice clean price action on gold. And the first one is very obvious. I think we all can see it. We have this really nice, breaks of structure, or we can call it, BOS if you want to. This is BOS because it's already bullish, break of structure. And what you can see is that price return back to the order block, right? So you can see here, we have this really nice order block. And what we can see is that we also see liquidity sweep, which is really nice, right? One of the best way to trade order block is when you see a liquidity sweep, because this signify that price sweep all the liquidity before it use that momentum to go to the upside, right? If we have liquidity below it, price might keep going to the downside, and that probably going to take your stop loss. So we don't want to see that. We want to see price sweep liquidity first before actually going to the upside, right? So after that liquidity sweep, what we can see next is that price immediately show wick rejection, right? Price go to the upside and actually break structure, right? So we have another break of structure, and in this case, it just come to the downside. So this is a market structure shift. Boom, beautiful, right? Close above, and then we come back, and again, as you can see, when it touched this order block, we have another big wick rejection. So we have 1, 2, 3 wick rejection from this order block, right? And every single time you can see that this high right here, when it come down, it can never close below this low. So this is a really strong signal that you can use to identify where it wanted to go next. You can see that this is the high, right? When it come down, it cannot close below this low right here. And same thing, when it goes up, it close. You see that? When it goes up, it actually close above previous high. But when it come down, it can never close below previous low. It is wick below, but it's not body close. That is a really big difference. We want to see a body close if we want to know if it's going to the downside or not. But this is not a body close. It is a wick below, but it's not a body close below. So this is signify that we are not bearish, we are bullish. Okay, so after this really nice wick rejection, as you can see, leaving a really small body, this is a strong bullish candle. And what we can see next is that we create another market structure shift to the upside. That is amazing, that is beautiful. And of course, we can also see that after that market structure shift, price fall back or kind of return, right? Pull back into this fair value gap or this order block right here. Really nice, right? So of course, from this, we can entry at this candle and target previous high, which is this 2 high, or what I call the equal high, because we have this wick that is not yet taken out this, right? When you see a wick like close to this wick, but it does not take out like this is what I call equal high, and it's one of the best target that you can use. It draws on liquidity, okay? So that is it. Very simple, clean entry. So this is of course the first one, which is the one that price respect the order blocks. But now let's go to the one that price do not respect the order block, right? So basically what it is that after this order block, price just come down and close below it and continue lower. And actually it is created right next to the previous one. for this one right here. So I'm going to remove this one first, and we're going to go straight to the second one. So as you can see, right, I'm going to remove all of it. The same order block as you can see here, but this one price did not respect it, right? Price just touch it and then actually continue to go lower. So if you go to a smaller time frame, let's just say your entry right here, right? So this means that you will be taking a loss right here, right? Because price just keep going lower. So why is that? So the first one is really obvious. You can see that this low, right? That price just sweep liquidity, the previous entry that we used. This one, it doesn't close below, but this one right here, as you can see, it completely closed below, right? And as you can see that it is a really strong bearish candle. So that is 100% a strong bearish movement, right? So that is the first difference we have to understand. Sell side liquidity, right? So the first difference is that this one has a more wick, that sweep the liquidity. This one, it doesn't have multiple wick. It just full body close below. So this is the first bad sign that you don't want to use, or you don't want to see if you want to go long from here, right? And after that, if you go to the smaller time frame, right, we can see that price did go up to the upside first right here, right? It gave us a reaction, but this do nothing. It doesn't break any structure. You can see to the left, it doesn't have any structure for it to break. It just a move to the upside. And if you look at the previous move, right, the move that it goes to the upside, it actually breaks structure. That is a really, really big difference. This one breaks structure. This one, right, breaks structure right here. And this one do nothing. It doesn't break any structure, right? So this one go break structure, but this one, instead of breaking structure to the upside, it actually breaks structure to the downside, as you can see right here. So this is a market structure shift or a break of structure. So you see the difference? On a higher time frame, it might look kind of similar, but on a lower time frame, it look different. One breaking structure to the upside, but one breaking structure to the downside. So based on this right here, it is make no sense for us to go long. It actually a possible reversal entry, right? Because like I said, when price show you a bigger pictures, we have to go to the lower time frame and see what it is that price doing. And in this case, instead of breaking structure to the upside, it actually break structure to the downside. So we actually can trade short here. And I think my previous video also talk about it. When it go to a strong level, instead of breaking structure to the upside like this, right, like that, and instead it breaks structure to the downside, we actually can short this when it come back to an order block, right? So in this case, we can short this when it go to this order block right here. Let me just throw it out. This order block right there, and stop we could put above the high and then target the low. And in this case, we got about 1-to-1 risk reward ratio, which is not the best, but also not bad. Consider, what price is doing. And the reason we short this is not just because of that, right? We have to look at the bigger pictures. We also see liquidity sweep, right? We have to take this into consideration as well. We have buy side liquidity that just sweep this buy side. We also have, right, this now, because of it close below like this actually turned into a market structure shift, right? So now we have a market structure shift, liquidity sweep, and then we go to a 5-minute time frame. We can see that it actually flip and create market structure shift to the downside, and that's why we can take that short entry. So this is the reason why one order block work and one doesn't. So now you know the reason. And because of what? Because of how price show different between the reaction when it touched the order block, right? Again, one, when it touched the order block, what does it do on this? Let's say this is a smaller time frame. It create this type of structure, right? So you can entry from an order block or a fair value gap. But the second one, I just show this to you so you can see what's happening. So this is a 30 minutes or 15-minute higher time frame, and this is a smaller time frame, 5-minute order block. We can entry from there, and this is the one that doesn't respect price order block, and it just go to the downside. It do this instead. So that is the difference, right? here. So instead of breaking structure to the upside, it actually breaks structure to the downside, and creating that, trap that a lot of people don't know. And when they see order block, they just enter it right away, and then it's not a good entry. It turns out to be a loss. But yes, that's it for today's video, guys. I hope you learned something, and I'll see you guys in the next one.